We have a very exciting video for all Tesla stock investors. Now, here in this video, we're going to listen to Gary Black, what he is looking forward to for Tesla, not just looking back at last quarter's disaster earnings call or... So here in this video, I think there's something you critically need to know as a Tesla stock investor. As Tom Lee says, in which you'll hear here in this video, the markets are starved of liquidity. And I think this is something that you really haven't heard anyone take into consideration. Now, in terms of Tesla, 2024 and 2025 probably are going to be great years for Tesla stock investors. 2024 is 2 months away, less than 2 months away. This is coming sooner than you might think. Now, in the short term, there are headwinds, there's problems. You might get an epic buying opportunity heading into 2024. We're going to go over that a little bit here in this video, but a vast majority of this video is going to be going over what I think is very underappreciated with Tesla investors right now. And I think you're going to get a lot of value out of it. At least it's going to open the door to a whole new thought with Tesla stock and your position. So we're going to get into that. Obviously, Gary Black, we're going to talk about the short term, my expectations for 2024, as well as Tom Lee. He does think we're in the second year of a bull market. And he does make a lot of good points that I think you should hear, guys. So let's go ahead and get into all of this information. If you are a Tesla stock investor, hit the like button. Subscribe to the channel if you guys want to stay up to date with everything going on with Tesla stock each and every single day, as well as the broader markets, and hit that notification bell if you half the time want to be notified by YouTube when a new video is put out. Hopefully that helps you become a wiser investor, make wiser decisions, and ultimately make more money. So first things first, we're going to acknowledge the short term. We've talked about this many times. I don't want to stick on it too long. There's a couple different things that are going on right now. The rise in bond yields is bad. The higher the bond yields go, well, the more incentive it is to put money into bonds, kind of a cash alternative, if you will, draws money out of stocks. So that's probably the number one thing that has affected the markets over the past 2 months or so, really ever since July, August, when you did hit that high for 2023. The second thing that is affecting the markets right now is this Israeli conflict. And let's be honest, guys, the markets are 12% off from hitting a new all-time high, and you are about 28.5% off of your 2022 low, which coincidentally was back around the same time in October of 2022. So on a risk to reward basis, there's a lot of room for stocks to come down here. Now, there's a lot of potential implications with this Israeli war. Do we get involved? Does Iran get involved? Does Hezbollah get involved? Is there a mixture of, that happening? What's the implication for oil, for inflation, for the economy? There's a lot of uncertainties. I've said it before and I'll say it again because who doesn't like to be redundant? The markets can handle bad news. They cannot handle uncertainty. This is all a bunch of uncertainty. And then we have a probable recession coming at some point down the line. One would argue that we've been in a recession for a long time. Consumers are not doing great. If you look anywhere, talk to anyone, people are not doing good. Okay, I don't know where the government's getting this phony data from half the time. Even Tom Lee says in this video, it's like a 1 hour long podcast. We're obviously not going to play it, but I'll let you guys know where to listen to it. Highly recommend you guys watch the whole thing. But even he says he doesn't know how retail sales came in so strong last month. Like it's a complete anomaly. Like someone's fixing the data out there. Okay, who knows, right? That you really got to have a tinfoil hat on for that one. But all I know is there's a lot more potential downside here than upside. Unless this conflict were to get resolved, the Ukraine-Russia conflict were to get resolved, inflation were to plummet, I mean, I don't really see where you get much upside from here. That's because on a relative price basis, you've already priced that good news in. Stocks, for the most part, are going to come down over the next couple of months. I don't think that's a big shocker if you are not hedged out in your portfolio. If that scares you, well, come join the trading community. Link down below in the description of this video. We will help you hedge if that's what you want to do. We are hedging our portfolios. We're making earnings trades. We're making some YOLOs here and there. We're doing all of it. Don't be scared of downside in the markets. This is a long-term game and you're at the beginning, okay? No matter what stage you are, this is the beginning of potentially a lot more upside to come. But you have to get through this near-term pain first things first before any of that upside is going to come. Like I have said before, Tesla stock, if the markets were to get really bad, could easily fall back to the 130 level. Again, that shouldn't scare you. If things were moderately bad, like pretty bad, 10, 15% down in the markets, well, you're probably falling to that 150 level at least. Now, 130 would be like a 30+% downside move for the NASDAQ. But more than likely, you're heading to that 190, 180 level with a 5 to 10% down move in the NASDAQ, which is more in lines with predictability, right? A 10% down move in the NASDAQ would put you at about 318. That would put you back to the same levels you were at in April of 2023 during basically the banking crisis, or right after the banking crisis in March. That's not too unrealistic. 15% down would put you back at banking crisis levels, around 300 on the NASDAQ. And then you start to get even worse from there. 26, 27% down would put you close to your October lows. And technically your October lows are about 28.5% down from here. So the downside is not too unrealistic. And Tesla, it doesn't exactly have a lot of good news going for it. So Tesla would probably be hit more than your average stock. And I think that's pretty safe to say. Let's go ahead and listen to this clip from Gary Black, and then we'll be back to go over my thesis on 2024, something critical that I think Tesla stock investors are just not even thinking about. Like, it's not even on the radar at all, that I think it very much should be. For 2024, at least the second quarter of 2024 throughout the rest of 2024 and ultimately 2025.
Gloves off in tonight's Times Square takedown. We are battling over the future of Tesla and the EV explosion. Our bear, the one and only fit and fighting trim Dan Nathan. Well, future fund managing partner Gary Black, who joins us on the fast line tonight. We had some technical issues with this picture. Gary, you'll get the first swing here. You still like the stock here? You know, a lot of people were commenting on the conference call that Elon sounded really down and out. He blamed everything under the sun, higher interest rates, a bad macro environment, geopolitical. But this is still your second largest position.
Yeah, look, the conference call was lousy. The earnings were lousy because they missed on the most important metric, which is auto gross margin. And the quality of the earnings were light because it was all based on reg credits and lower tax rate. But when you think about the stock, it's trading now at 52 times. It's growing its volumes and earnings at 35% between now and 2027. I'm a growth manager. I can't find stocks that trade at 52 times that are growing at 30 to 35%. So we still like it.
In terms of volumes, you had noted on Twitter, Gary, that past price cuts didn't yield an increase in volume, and there's concern now that Tesla will continue cutting price in order to compensate for higher rates, which would hit the consumer in the form of the auto loan, auto financing. So, you know, to what end do they cut price at this point if you say that the incremental volume is just not materializing?
Yeah, there's been no demand elasticity, despite what Elon says. You know, if you look at where the estimates for 2023 were at the beginning of the year, and then you look at where they are today, they're exactly the same. If you go out to 2024, they're actually lower. So you're not getting any volume growth for these price cuts. So we've been advocating stop cutting price, put some money into advertising, use that as another tool in your marketing toolkit to try to get more volume. Because I don't think by cutting the price of the Model Y from 50,000 to 48,000 is going to get you any more incremental volume. And I'll go so far as to say that if you look at monthly payments of a Model Y today, if you took out a 5-year auto loan and rates have gone from 4% to, let's say, 7.5%, but the price of the Model Y has come down by 20%, the payments are actually lower today than they were a year and a half to 2 years ago. So I don't understand the logic of why they have to keep cutting the price. And look, I think at the end of the day, they're going to see that they're not getting any demand elasticity, despite what they said on the conference call last night. So we think that there might be another couple of price cuts, and we may see margins come down a little bit more. But I go back to, I got a stock trading at 52 times next year's earnings, growing at 35% a year, and I can't find stocks that trade at a PEG of 1.5 in the growth universe.
Right, but Gary, you know, that revenue growth is decelerating, right? The delivery growth is decelerating. And I remember listening to you, I think it was on the last call in April after the Q1 earnings report. And I remember, I think you said that you sold a part of your position. You were not happy with the price cuts. That was all the way back in April. And if I look at this stock and I look at now the three reactions the day after it's reported, it's Q1, it's Q2, and it's Q3, it sold off basically 10% each time. So the big money out there is selling on those days. You seem to be very frustrated with his strategy. You seem to not buy the math that he's giving. And the CFO, who does all the math, right? Like, he left a couple months ago without really a statement or anything like that. So maybe there's some funny math going. And I listened to the same call that you listened to, and I give you a lot of credit. I was reading your Twitter this morning. You were being very honest about it. Are you selling, if you were selling stock after the Q1 call when the stock was $175, are you selling stock here at $220? Because it looks like the fundamentals of this company, at least as it relates to the autos, are deteriorating. And if simple math about price elasticity is not working for this company right now, why are you sticking around waiting for that growth to decelerate further if that's the case? And we haven't even had the recession yet, okay? So that's the other point I would make.
Yeah, well, we got a couple catalysts ahead. So one, the Cybertruck is going to be huge. If you go out and you talk to pickup truck owners, and you got to talk to all of them. You can't just talk to 65-year-olds who drive F-150s. You talk to 30-year-olds, 40-year-olds. We go out and we do that. What you find is people love the look of the Cybertruck. The Cybertruck will be out in about 2 weeks. It's going to be a rolling billboard, and you're going to see it, and you're going to get excited about it. And you may not buy a pickup truck, but you're going to go to the Tesla website. You say, wow, that's really neat. What is it? I can't even imagine the social media buzz that you're going to get when that Cybertruck starts rolling all across America. And there's a halo effect that will come with that. They'll ignite the entire franchise. That's one. Two, they didn't talk about this. I'm not sure why, but there will be at some point an FSD licensing deal with another OEM. It's probably going to be like a Toyota or a Honda, and that's going to get people very excited because there's going to be other FSD licensing deals. And then the third thing is that the energy business, which has always been very small, is now the highest margin business. It's 24% margins. The auto business is 16. That thing tripled in the third quarter versus the third quarter a year ago, and people aren't putting any value whatsoever on that. So I think there's a bunch of catalysts ahead. And then the $7,500 IRA credit is going to go to off invoice January 1st. So I got a lot of catalysts, and you're right. The volumes have been decelerating. We're probably, if they hit 1.8 million for the year, that means that their volume growth for the fourth quarter is only going to be 18%. But I think they can get back to 30%.
Now, I think Gary Black said it perfectly. Tesla trading at 52 times earnings on a PE basis, growing at 35+% over the next coming years. He said until 2027. We'll see. It could go longer than that. It could be more growth than that. I think capacity is going to be an issue once we start to get even higher from here as far as delivery numbers each and every single year. But nonetheless, you really can't find a stock with the quality of Tesla with virtually no debt, trading at valuations Tesla's trading at. Now, what everyone is missing, Elon made it very clear. There was one thing I walked away from that really stuck out to me on the earnings call. It was Elon and Tesla, they're cutting prices because the monthly payment on Teslas would be egregious right now if the price was the same as it was a year or two ago for Teslas, right? I'm looking at getting a new Model 3. And if you put 0% down, it's like $600 some a month. If you put $4,500 down, which is like the standard, like 10% or whatever, you're still looking at like $500 and some a month. Most people cannot afford that. So I don't think it's a demand problem with Tesla. I think it's more of a financing problem, that too much of that monthly payment is going towards interest alone, and it's just driving up that monthly cost. Now, what are we expecting for 2024? Well, markets are currently expecting 2 to 3 rate cuts in 2024. Tesla, I think, will be able to raise prices in 2024 as the rates do come down. Now, if the economy does deteriorate faster than what we expect, or the markets currently expect, Tesla will be able to cut prices a lot more, or raise prices a lot. See, we're just so used to saying cut prices, raise prices is like totally off the radar. Tesla will be able to raise prices even more than maybe what I even expect in 2024 because Elon made it very clear. It's not about the price of the vehicle itself. When 90+% of your business has to do with financing, it's all about the monthly cost of that payment. So as rates come down, expect prices to go up for Teslas to match a similar, payment as what people are paying today, $500-$600. Elon doesn't want $1,000 payment to get into a Tesla. You're not going to sell that many Teslas. That's probably not the best way to do it. Tesla has the margins to cut prices now. That's the thing I want to really highlight for you. The big story has been margins. Tesla right now has been forced to some degree to cut prices because of, again, the monthly payments. But to counteract that, Tesla has been working day in, day out to lower the cost to produce vehicles, to lower the manufacturing cost, to lower the material cost. That will pay dividends to come for a long time. So once you get these costs down, they can obviously rise a little bit during, different environments. But by and large, they stay down. They're not going to shoot back up. So today is the cheapest you've ever seen for Tesla to produce a vehicle. The price is also the cheapest we've seen to be able to ever buy a Tesla. But when Tesla raises prices, you could see the best margins we've ever seen for Tesla, or at least back up to where they were like 2021, 2022. That I don't think is something that investors are even looking at here. And if margins do increase because Tesla has their cost to make Teslas at the lowest they've ever been, and rates come down, maybe more than what we're expecting, maybe a slight recession does come, Fed does cut rates, maybe like 3%, 3.5%. Tesla's able to raise prices, call it $5,000, $10,000 on the Model 3, Model Y, because your payment's going to roughly be the same. Well, Tesla just added that incremental, price increase to their margins. That could make Tesla way cheaper in 2024, probably towards the second half of 2024, than it even is today, trading at 52 times earnings. If Tesla were to raise prices $5,000 to $10,000 and see volumes increase next year, Tesla really could be trading at a 30 times PE, maybe even less than that. Again, it's hard to forecast the future. That's why I think Wall Street is not even paying attention to this. But the elasticity, as Elon says, with demand for Teslas, well, the margins to actually produce these vehicles, that's very applicable to that. Once you get your costs down because you've upgraded your production lines, you've made things more efficient, usually your costs stay down or even continue lower. Whereas it's all about that monthly payment. Rates come down, price of the car goes up to give you a somewhat similar payment as you are seeing today. It's as simple as that. And I don't think Wall Street, I haven't heard anyone talk about that, not on YouTube in this community that, are just us covering Tesla, or on the analyst side. I haven't heard anyone talk about that. And I think that is a critical piece of the puzzle that I think will come back and will be a main highlight of Tesla in 2024. I don't know about the beginning of 2024, but at least by this time in 2024, 1 year from now, everyone's going to be talking about what I'm talking about now. Margins are just going higher because Tesla's able to raise prices, and they're still seeing good demand. A lot of that could be due to the Cybertruck, the halo effect we're going to see. But, I mean, how can you not be excited by this? I think it's kind of common sense. Once you actually hear this, let me know if this makes sense to you guys. If not, maybe I can try to break it down with more specifics here. But point is, Tesla has been forced to try to save their margins today and still cut prices by reducing the cost to make the vehicles. Those cost reductions, well, they're going to stay the same. Tesla's able to raise prices as rates come down in 2024. That means a lot more money going to the bottom line. That means a much lower valuation potentially for Tesla in 2024. And that's where you get a lot of upside for Tesla stock. Not to mention what Tom Lee says, in which I think is very prudent to pay attention to as well. The markets have been just drained of liquidity. I think stocks would be way lower today, way, way lower today, if you did not have market makers, because nobody's really buying stocks, as Tom Lee says.
How do you think about going into a second year of the bull market? And what are some of the things that we should keep an eye on to feel confident that it's continuing?
If I was to sort of think of it as how a skeptical investor is going to look at next year, I think there's so many things that flip from negative to positive. The first is really the trajectory of inflation. I mean, we've seen a huge drop in inflation in the past year, and yet when we talk to those skeptical, they're like, well, hey, the drop from 10 to 3.5 was easy, but going from 3.5 to under 3 is going to be really hard work. So inflation's sticky.
Yeah.
I don't know. That's just someone's opinion. We'll see. We've done a lot of work on inflation. I mean, 2/3 of inflation is essentially housing and cars, and I sure don't think those are sticky. So I think next year that flips positive. And the second is what the Fed will do. And there's two parts to that, because we know Fed has two tools they're using. One is actual rates, and I think they're going to be, I think the highest probability is that they've already finished hiking. And next year that could be cuts if inflation tracks the way we think. But the second part is there's a lot of people that think it's now the word of the Almighty that interest rates are higher for longer because the Fed has deemed it so. As you know, that's a communication tool. That's Fed's imagination of where rates need to be. I think next year
They could change their mind.
Exactly. Yet so many people take it set in stone, and that could be a huge surprise. I think rates, Mark Newton thinks you could even be in the 3.5-ish next year on the 10-year yield, and that would be PE expanding.
Wow.
Yeah. And then other things that are positive next year is, Europe is what broke, and China is what broke from monetary policy hikes, and they could be coming out of this as well. And on the geopolitical side, I don't know what's going to happen, but it doesn't have to be widening and worsening next year. That's a little bit unknown. And then fourth is investors, if the first three things happen, they're going to move money back into equity. So I think Ari's point is correct. Next year should be even stronger than this year for those reasons.
All right, so getting back to the idea that this has not exactly been a rip-roaring bull market, which again, we didn't even mention the regional bank disaster, which impacted the market for a whole 10 days, if that. So a couple of charts from Yuri and Timmer. This was he tweeted this at the end of September. If stocks entered a new bull market last October, you never know it by looking at the small caps. In fact, this would be the weakest small cap start ever for a new bull, which is not good considering that small caps normally outperform on the way up. And then he also shows the S&P 500. The black line is the rally to date. The blue line is the average. How do you think about something like this?
Well, I think there's two ways to think of, because the chart is correct. One is to say that, well, if it's not a sample, so small caps aren't doing well, then this isn't a bull market. But I think the other way to view this is, well, small caps are really only benefiting if there are actually people buying stocks. So I think that their weak bounce is consistent with the idea that this has been a really liquidity-starved bull market. Michael, I don't remember all the specifics of 2009, but I do know when I was at JP Morgan, I think for the first 2 years, people had given me many reasons to argue why that wasn't even the start of a bull market, that it was all a head fake. And it's very similar. People would have different charts about how EM isn't doing this, or, hey, your leadership is coming from the wrong groups, or, hey, why are flows doing what they're doing? And I think in each case, people were arguing why the move from 2009 all the way through 2011 was actually not really a bull market. It really wasn't until maybe 2012 that people acknowledged that the bottom, in fact, was in.
And then two points on that. You mentioned the potential head fake. I remember, I think it was the fall of last year, there had never been a bear market rally that retraces 50% of the previous loss and then went on to make new lows. I think Ryan Dietrich was tweeting that, Yuri and Tim, a lot of people were talking about that. And nobody believed that October 2022 was the bottom. Josh and I were in a room full of people. Raise your hand if you think a recession is coming. Every hand went up. Raise your hand if you think October was the bottom. No hands went up. Nobody believed that rally was anything other than a bear in disguise. And so even though we haven't gotten the outperformance that you've seen from small caps historically, well, it makes sense. These are the companies that are most sensitive to interest rate hikes. The S&P, 90% of the debt is long-term fixed. These companies have a lot of debt that's maturing over the next 1, 2, 3 years. So it does make sense that they're not outperforming to the way that they did in the past. One thing I want to mention, which I think is pretty interesting in terms of the current market environment, in terms of small caps perhaps behaving the way that you would expect, given where interest rates are, and Tom, as you mentioned, given the fact that equities have had persistent outflows. If you look at the ARK Innovation ETF, which is a proxy for Goldman Sachs Unprofitable Tech Index, if you look at that divided by the Qs, that actually hit a new cycle low today, which is pretty remarkable considering the beating that's already taken.
Yeah, I mean, it's that chart sort of speaks to, I'm looking at it now, I mean, it kind of speaks to me of many things. One is it shows you investors aren't embracing innovation either. Speculative growth or speculative ideas, crypto kind of falls in that same category as well. But, it has been a narrow market. I mean, it's kind of hard not to acknowledge that, but the things that have outperformed to me have been logical leaders too. So I don't know if I would say in 12 months, the ARK fund won't find a bid, but I think in this, environment of caution by companies and consumers and businesses, to me, it's understandable why it's been a narrow market.
So now that we're to the end of this video, let me know what you think about this down below in the comment section. Let me know where you think Tesla's going in the near term as well as 2024. If you guys want my honest opinion, again, 150, it wouldn't be too out of the realm of crazy or reality to think that could happen, especially if we get moderate downside in the markets, which I do think is going to happen. So 150 doesn't sound too unlikely. 180, almost a guarantee in my personal opinion. If you can get Tesla around those prices, I think once the markets fully realize what Tesla has to offer in 2024, the margin boost that we're going to see, the profit boost that we're going to see, and the lower valuation in 2024 and 2025, right? Second half of 2024, beginning of 2025, that's probably when these things really get realized by the markets. Tesla stock is going to be at new all-time highs. That's my opinion. Especially if rates do come down and you get multiple expansion and you get more money flowing into Tesla stock, flowing into the markets because maybe there's an appetite to buy stocks. That's not even accounting for that. So just on a pure numbers basis, a valuation basis, you could see easily Tesla stock at new all-time highs if they're able to raise prices with the current cost to make their vehicles. The current cost to make a Tesla is now, what they say, $37,500, which is the lowest it's ever been. Give or take, I'm sure that's not the set price, but give or take around that range. Well, just wait till they start raising prices. Wait till the Model Y is $55,000 again, or $50,000 again, or, even potentially more than that. Obviously, different variants cost different prices, but Tesla's going to see a lot more money to the bottom line. And you get an appetite for investors to buy stocks. That is a very good recipe for Tesla stock to go much higher in the back half of 2024, potentially in the beginning of 2024. I think it really depends how this holiday season does go, how GDP goes, how the economy goes, how this conflict with, the Middle East plays out. But more realistically speaking, the second half of 2024, beginning of 2025, that's when you want to have your position really built out in Tesla, in my personal opinion. Right now is your accumulation stage. Right now is not when you want the gains. You want as much time as possible to buy as many shares of Tesla as possible before we get to that moment in time where Wall Street figures out exactly what I am saying. So that's going to do it for this video. Hit that like button, subscribe to the channel, and source your comments, questions, or concerns down below in the comment section. You guys have a great rest of your day and your weekends, and I will see you in the next one.